Good morning, everybody. My name is Amrish Jain. Today we are going to study about cash flow statement. Cash flow statement is a statement which a company has to prepare as per accounting standard 3. Accounting standard 3. There are two ways in which cash flow statement can be prepared. Number one, direct method, and number two is indirect method. As per accounting standard 3, a company has to follow indirect method. In further classes, we will see how to prepare cash flow statement. But for today's lecture, we will study the basic of cash flow statement. What is cash flow statement? For what cash flow statement is prepared? And what are the different categories of cash flow statement? So let's start our lecture. Let us first understand what is cash flow statement. Cash flow statement is basically a statement in accounts or finance. There are two things which we prepare. One is account, another is statement. Account is something which is prepared on the basis of rules of debit and credit, but statement is something which is not prepared on the basis of debit and credit. It has its own rule. Like suppose bank reconciliation statement is a statement which is prepared on some different basis. Similarly, cash flow statement is a statement which is prepared on certain basis. We'll see that. So what is cash flow statement? Is a statement which shows the inflow and outflow of cash and cash equivalent. Cash and cash equivalent under three different categories. So basically it's a statement which shows inflow of cash and cash equivalent and their outflow from the business under three different categories. Why it is prepared? The question is, say for example, cash and cash equivalent are very important thing for a business. There are different kinds of cash and cash equivalent, and they are very important for the business because if it is not managed properly, the record has not been kept properly, there may be a fraud, there may be chances that cash and cash equivalent may not be used properly the way they should be used, and it also helps in analysis from where the business has generated cash, whether it is from operating activity or from financing or investing, or where they have used the money. So it gives a complete analysis of the performance of that company. So let us first understand what is cash and cash equivalent. As we have seen that cash flow statement is prepared to show the inflow or outflow of cash and cash equivalent. So first of all, we have to understand what is cash and cash equivalent. Cash, you don't know, cash means money, your cash in hand. A company, a business always keeps some money in hand for day-to-day purposes. Apart from that, they keep some money in bank. They have some checks in hand, drafts in hand, and marketable securities. Combination of all these things are known as cash and cash equivalent. Cash equivalent is likely similar to cash. Means anything which performs the same function as cash. I'll give you an example. Say for example, if you want to buy something, you have some money, you immediately spend that money and buy that. That is cash. Now anything which you can give in exchange for something without losing its value is like cash or cash equivalent. Say for example, the money you put it in your bank, you pay it by check or by net banking or by card, that is also like cash and cash equivalent. Checks in hand, you don't lose any value while making payment through checks and draft, which is in your hand. Similarly, marketable securities. What is marketable securities? Marketable word means which can be traded, which can be sold and purchased in market without losing its value. That means if you want to sell that security, suppose government securities, which are very much flexible, which are very much liquid in market, you buy it, and if you want to sell it anytime, you can sell it without any kind of penalty, without any kind of losing your money, and hence it is very much similar to or equivalent to cash. Now every time I am using the word without losing value, that means what? Say for example a land or a building, it is not like cash and cash equivalent. Why? That can also be used for making transaction. But what happens? Say for example you need some money and you have a land. Now what do you have to do? First you have to sell that land because we are not following a barter system. Now if you are selling any kind of fixed assets, immediately you want money. First of all, it will take lot of time to sell that land because you have to buy a buyer, and second, you have to get it the correct price. You have to get the correct price. So mostly what happens, you don't get the required buyer on time, and even then when you don't get the required money, so you lose your value, and hence it is called not as cash equivalent, it is something else. So what is cash and cash equivalent? Cash and cash equivalent means which is cash or similar to cash. You can use it just like cash. So as for now, for class 12 is concerned, there are 4 categories which are considered in cash and cash equivalent, 4 items. Number 1 is cash itself, then cash at bank, then checks in hand and marketable securities. Now for these 4, we have to prepare cash and cash equivalent. That means inflow and outflow of these 4 things are shown in cash and cash equivalent, cash flow statement. Now these are just like this, they are not shown as inflow or outflow. They are shown under different categories. Now those categories I have written here. This is operating activity, investing activity and financing activity. That means when you prepare cash flow statement, you have to categorize the inflow and outflow. That means how much you have received cash and cash equivalent under operating activity, how much you are paid similarly under investing and then financing activity. So let us first understand, which is very important, to what are those activities, what kind of transactions comes under this kind of activity. Then only we can prepare cash and cash equivalent, that is cash flow statement, with the help of these different types of categories. Now what is operating activity? Operating activity means those activities which are done on day-to-day basis for the regular survival of the business. For day-to-day activity means like you buy goods, you sell goods, you make wages, you make payment to your staff, you make payment to your laborers, you pay electricity bill, etc., etc. So any activity which is done on a day-to-day basis for the performance or the regularity of the business is known as operating activity. Investing activity. What is investing activity? See, business is also a kind of investment. When you put money into business, it is a kind of investment. Now, in what we put money in business is, if you remember balance sheet, there are 2 parts of balance sheet. One is asset side and one is liability side. Asset side means use of money and liability side means source of money. So investment is always use of money, where you have invested money into. So when we are talking about investing activity in cash flow statement, we are talking about investment into long-term assets. That means land, building, plant, machinery, tangible, intangible assets. As per your balance sheet of a company, we call it FILO. That means fixed assets, investment, loans and advances, and other non-current assets. So these are the categories where we invest in business, and that category is known as investing activity. Apart from that, we also make investment in short-term assets, which is also known as non-current assets, which are also known as current assets. But those activities are considered under operating activity, current assets, because they are required for day-to-day functioning of the business. So investing activity basically includes all those investment into long-term assets. So purchase will result into outflow of cash. When we purchase land, land comes in, but cash goes out, and we are preparing cash flow for cash and cash equivalent. When you sell any kind of long-term assets, that is inflow out of investing activity. So operating activity, day-to-day activity, which you do on a regular basis. Investing activity, basically investment in long-term assets, non-current assets, fixed assets, tangible or intangible. And now comes to the left side, that is liability side of the balance sheet. In order to invest in business, you need to arrange some money, you need to arrange some finance. You arrange it through equity or through debt. That means either you invest as an owner or you take loan from bank or etc., debenture, etc. So these are the activities from where you generate money, and that is you finance into a business, you get money for the business, and those activities are known as financing activity. So basically, if you see, investing in operating activity, day-to-day activity, investing activity, investment into long-term assets, and financing activity means those activity which helps generating money for the business and obviously returning back the money. That means if you have taken loan, that is inflow under financing activity. You have repaid the loan, that is outflow under financing activity. If you have issued share, that is inflow under financing activity. If you have buyback those shares, that means you have refunded the money to the shareholder, then it is outflow under financing activity. Now, once we start preparing cash flow statement, you will see that we start from operating, then investing, then financing. This is the way we prepare cash flow statement. So today we have understood the basics of cash flow, where we have understood what is cash flow statement, for what cash flow is prepared, that is cash and cash equivalent, items included in that, and what are the different categories under which cash flow statement is prepared.